What is accounting? Accounting is the process of recording, summarizing, analyzing, and reporting financial transactions of a business, organization, or individual. It provides a clear financial picture, enabling informed decision-making and ensuring compliance with financial regulations. History of accounts. The history of accounts traces back thousands of years, reflecting humanity's need to record and manage economic activities. The earliest known accounting records date to around 3000 BCE in Mesopotamia, where ancient civilizations used clay tablets to track transactions involving goods like grain and livestock. These records were vital for trade, taxation, and administration. The foundations of modern accounting were laid in the late 15th century by Luca Pacioli, an Italian mathematician and Franciscan friar, who published Summa de Arithmetica, Geometria, Proportioni et Proportionalita, in 1494. This work detailed the double-entry bookkeeping system, a revolutionary method that remains central to accounting today. Types of accounting. Accounting can be classified as follows. Financial accounting focuses on preparing financial statements for external users. Managerial accounting provides detailed financial information for internal decision-making. Tax accounting deals with tax planning and compliance with tax laws. Cost accounting analyzes costs to control expenses and set pricing strategies. Forensic accounting investigates financial discrepancies and fraud. What is financial accounting? Financial accounting is a branch of accounting that focuses on the preparation, presentation, and analysis of financial statements to provide an accurate picture of an organization's financial performance and position. It is primarily designed for external stakeholders such as investors, creditors, regulatory authorities, and the public. Key features of financial accounting: preparation of financial statements, focus on historical data, compliance with standards, external reporting, objective nature. Why we need accounting. 1. To keep financial records. 2. For decision-making. 3. To measure performance. 4. For compliance with legal requirements. 5. To secure financing. 6. For budgeting and forecasting. 7. To detect fraud and errors. 8. To facilitate business operations. 9. To provide information to stakeholders. 10. To ensure business continuity. In accounting, we mainly deal with business transactions. So what do we mean by business transactions? Business transactions are economic events or activities involving exchanging goods, services, or monetary value between two or more parties. These transactions are measurable in monetary terms and are recorded in the books of business accounts. Examples for business transactions are: 1. Purchasing goods for $50,000 from X Limited. 2. Paying employees a monthly salary of $5,000. 3. Selling a stock worth $250,000. 4. Paying a phone bill of $1,000. 5. Value of goods destroyed by fire was $30,000. Mainly there are two types of transactions: cash transactions. Payment is made or received immediately in cash. Example: paying wages in cash. Credit transactions. Payment is deferred to a future date. Example: buying goods on credit. Accounting is a process. It includes input, processing, and output methods. So, what do we mean by input? The input stage involves collecting and recording raw financial data. This includes transactions like sales, purchases, expenses, and receipts. These details are entered into the accounting system using documents such as invoices, receipts, and bank statements. What do we mean by process? In the process stage, the recorded data is classified, summarized, and analyzed. This involves posting entries to ledgers, preparing trial balances, and applying accounting rules to produce organized financial records. Modern software automates much of this process. Finally, what do we mean by output? The output stage generates reports and insights based on processed data. Examples include financial statements, income statement, balance sheet, and cash flow statement, and other management reports. These outputs help stakeholders make informed decisions and evaluate financial performance. The first lesson of the Introduction to Accounting series is finished. Now, try to answer the following questions to check your knowledge. Question 1. What is the primary purpose of accounting? Answers are as follows. A. To record personal achievements. B. To document and analyze financial transactions. C. To calculate market prices. D. To create business advertisements. So, what is the correct answer? Question 2. Who is known as the father of modern accounting? A. Adam Smith. B. Leonardo da Vinci. C. Luca Pacioli. D. Alexander Hamilton. So, what is the correct answer? Question 3. Which type of accounting is focused on creating financial statements for external users? A. Managerial accounting. B. Tax accounting. C. Financial accounting. D. Cost accounting. What is your answer? Question 4. What is an example of a credit transaction? A. Paying wages in cash. B. Buying goods on credit. C. Receiving payment immediately for a sale. D. Destroying goods by fire. What is your answer? Question 5. Which of the following is not a reason why we need accounting? A. To measure performance. B. To detect fraud and errors. C. To track global market trends. D. To provide information to stakeholders. Your answer, please? Final one, question number 6. What are the 3 main stages of the accounting process? A. Collection, summarization, adjustment. B. Input, process, output. C. Recording, analysis, audit. D. Data entry, verification, reporting. You answer, please. Okay, let's meet with the second lesson soon. Thank you.